Take a look here at the wild arc of Bitcoin's price since its inception in 2009. At first glance, this has been an endless trip up and to the right. Nothing but life-changing wealth for those who hopped aboard this train early. That's because what this chart doesn't show us is all the volatility that's happened in between.
We've seen plenty of volatility when you look at the pricing of Bitcoin, when you look at the pricing of Ethereum and many of the other digital currencies.
First, we need to talk about the key, repeating event that sets the rhythm for Bitcoin cycles, the halving.
The halving.
The Bitcoin halving.
The halving.
Let's go straight actually to the halving or the halvening.
Now, in case you're not familiar, the halving is when Bitcoin's supply emission is slashed by 50%. This means that immediately after each halving, less supply is readily available for sale. Now, at the same time, demand for Bitcoin has historically spiked around each halving. So this combination of supply falling while demand rises has led it to its most rapid price expansions over time. The extreme deviations which have led pricing to euphoric, high volatility tops.
Bitcoin just hit an all-time high moments ago. $62,000 have been breached.
And boring, low volatility, capitulation-based bottoms of each cycle within the larger uptrend. As anyone who spent time navigating Bitcoin can tell you, timing here is everything. Timing is the difference between fortunes made and fortunes squandered.
Tonight, a massive sell-off of cryptocurrency, erasing more than $200 billion from the entire market in a single day.
Especially for someone who's looking to make outsized returns on Bitcoin by using leverage rather than a basic buy and hold strategy. One way to do this is by trading leveraged futures contracts. But as we all know, those are prone to things like predatory scam wicks and forced liquidations that can evaporate your trading capital overnight. This is where the advantage of options shine, and in no market is timing more important than an options trader.
That's why today, and throughout this series, I'm going to show you a proprietary adjustment we made to this chart, which will give you an inside view into my personal options trading strategy, and show you how I use it to properly time the market's ebbs and flows.
Before we begin, some quick background on me and my experience in this market. Though you may know me as your friendly internet janitor JJ, I've actually been an active trader in crypto for some time and have the scars to prove it. I started trading Bitcoin and Ethereum in 2016, and I've been actively trading options and derivatives full time since 2019. I can tell you beyond a shadow of a doubt, having this knowledge that I'll be teaching you today, when I first started, would have saved me a ton of time, money, and heartache. This framework is a theory I've had in mind for some time, and thanks to the help of Ben Lilly and the teams at CoinCall and JLabs Digital, we were able to take it a step further and turn it into a tangible, easy to follow guideline that will make options trading practical and accessible for everyone, regardless of your current experience level. But without further ado, let's dive in. It's a little secret that Bitcoin's bull cycles have been all centered around the halving event. So if we highlight the previous halving instances on the log chart I showed you earlier here, the pattern becomes crystal clear. We see the first halving event happened in November 2012 when Bitcoin was trading around $12. Just over a year later, Bitcoin was trading above $1,100, a gain of over 9,000%. The second halving took place in July 2016 when Bitcoin was trading at roughly $650, and by the end of the next year it was priced over $19,000, a gain of over 2,800%. And then we see the most recent halving event of May 2020 that took it 530% higher, from a price of roughly $10,000 in May 2020 to over $63,000 in April 2021. And finally, we see the next halving event scheduled for April 2024. Now what you may notice is the percentage gains for each cycle have been declining, from 9,000% after the first halving, to 2,800%, to just 530% in the most recent cycle. This isn't a surprise, and it's likely to continue in 2024. Another reason why learning what I'm going to teach you today, how to play this cycle with options, will be so valuable if you're looking for outsized returns. Now, should next year's halving spark a bull run and the pattern repeat itself, the opportunity to make some of the biggest gains of your life will be readily available, but you're likely not going to see those 10 to 1000x returns if you're just playing spot alone. Those days are over. With options, however, these sort of life-changing gains are still possible, but only if you have a plan and know how to navigate the smaller waves within the larger tsunami. This brings us to our next chart, and that'll give us some insights on how to do that. Here we see the original Bitcoin rainbow chart, made by the team at Data website Look Into Bitcoin. What this shows us is the different psychological sentiment regimes, each marked by a specific color, that repeat time and again within Bitcoin cycles. This gives us a window of insight into the behavior the market demonstrates when prices at various stages. Savvy traders and investors use this to time their trades with reliable precision. As we see, there's the friendly reminders to sell it all when we reach maximum bubble territory in the red, such as December 2017, and instructions to buy when price reaches depressive lows, like in 2020 just after the COVID crash, when a full Bitcoin could be bought for just $3,000. This chart is definitely useful for buying and selling spot Bitcoin, but not so much options. As with options, it's all centered around things like precise timing and an understanding of volatility levels, which this chart doesn't identify. Again, the benefit of options is they give us access to unlimited leverage, which will lead us to much higher returns over time with no liquidation points. So what I'm going to show you next is a proprietary adjustment we made to this original rainbow chart in order to create a simple and easy to follow options trading framework. This framework will enable us to capitalize on these extremes in sentiment and far outpace the returns we would earn if we just traded basic spot or futures contracts. And here we see it. We call this our options trading regime cycles chart, and it's one of the most valuable metrics in my toolset. What we did here is strip away the shading and separated Bitcoin cycles within the larger cycle into 4 distinct regimes of volatility. Just as a reminder, volatility is the measure of Bitcoin's active trading range and affects how options are priced. When volatility is high, the cost to buy options will be pricey, and when volatility is low, options can be bought for cheap. In the ensuing videos, we'll unpack the nuances of each phase and how to trade them with options depending on whether we're ascending or descending into these ranges. But for now, I just want you to focus on the different volatility regimes we see here and their defining characteristics, which we'll be covering today. Again, this is the foundational key to understanding this framework and unlocking massive profits in 2024. First up is the blue phase. These are the times when volatility is low, mind-numbingly low. These time periods are characterized by low trading volumes and a lack of participants in Bitcoin's market. It's your typical bear regime where retail is nowhere to be found. A perfect example of the blue phase would be December of 2022. At that time, just after the FTX collapse, Bitcoin was in an abyss after falling to nearly $15,000, and most market participants had either been liquidated on the way down or were sitting on cash waiting for prices to fall lower. As a result, there just wasn't a whole lot of buying or selling going on, and price simply drifted sideways for a couple months. Although Bitcoin did spike back up off the bottom in January and recovered throughout 2023, even at the time of recording in December, just before 2024, we're still not out of this blue stage, believe it or not. We know this because volatility levels, again the most critical part of options trading, haven't yet recovered back to their average range, as we see here on the BVOL, BitMEX's historical volatility index. This index is the oldest measure of Bitcoin volatility we have, as it dates back to 2016. What it depicts is Bitcoin's volatility on a scale from 0 to infinity, although for most of its lifetime it's oscillated between a score of 20 to 100. Since August 2022, we've been firmly stuck below 30. This basement level volatility is a telltale sign of the blue phase we still find ourselves in. This also tells us that despite Bitcoin's massive run-up throughout 2023, options can still be bought on the cheap, at least on a relative basis. Historically speaking, we're not in a volatility bull market until BVOL is regularly trading above 50. Now, does this mean you don't ever want to buy options in the blue regime? Of course not. When options are as cheap as they are in this phase, they present opportunities to get long and play the mini spikes that happen here on occasion, such as when Bitcoin went parabolic above $30,000 this past October. It simply means most bounces in volatility during this phase will be muted and short-lived, as we can see here when looking at BVOL's 2023 performance throughout the blue phase. And if you are playing options during the blue phase, you should be a seller on those bounces in volatility, rather than waiting in vain for the type of volatility that only comes about in full-blown bull markets. Again, we'll cover more in the next video on the specific ways you can take advantage of the short bouts of volatility while remaining directionally exposed to Bitcoin's larger uptrend. But for now, let's move on to the green phase. The The green phase is the time period when price is expanding off the previous cycle's bottom and breaking into new ranges, though not yet trading at all-time highs. As a result of the price expansion, volatility levels are increasing, but they're not yet at alarmingly high levels. This is typically the Goldilocks period to become a long call buyer. Our most recent example of this would be November 2020, when Bitcoin finally broke above 14,000, which had held as resistance for nearly 3 years prior. Looking back at the BVol chart again, we see this is the range when volatility went from compressed to expansive as the options market rapidly repriced itself to the probabilities of higher prices in the future. During that November 2020 breakout in BVol, it rose from a compressed range of 20 to 40 to a November high of above 70, and a high around 135 the following January. That November was when all-time highs became a matter of when, not if. And if you were savvy enough to buy calls in November, you'd have netted yourself some wild profits a few months later when Bitcoin multiplied to over 60,000 and call options premium skyrocketed. In 2024 terms, we would exit the blue phase and enter the green if Bitcoin broke and held above the 50,000 range. If that consolidation were to happen above 50,000 in 2024, here's where you'd be looking to get your hands on as much long-dated volatility as the market is willing to sell you. Then there is the yellow phase. Think of this time period just like the yellow signal on a traffic light. Here there's still juice to be squeezed higher, but when price reaches this point in the way up, volatility tends to be overheated, and you should be looking to book some of those profits on the calls you bought during the green phase. If we look at where we were when we last hit the yellow range on the way up, it was in January 2021 when Bitcoin first breached the $30,000 to $40,000 region. Though prices continued higher into April of that year, it was more of a slow grind up as compared to the parabolic ride of November to January that sent BVol to its cycle peak. This means that after the leg up to $40,000 in January, the cost to buy options was no longer outpacing the amount of volatility realized on a daily basis. This meant higher premiums and smaller returns. The risk-reward of being a long options buyer was simply no longer there. If we refer back to the original rainbow chart, we see that if price were to reach the yellow post-halving in 2024, it would be at a price of over $110,000. Now this doesn't mean price would necessarily top if we got there, but realized volatility levels likely would. Such a rapid spike in volatility is where you would want to begin deleveraging yourself of long positions if you've played the green phase correctly. Again, we'll be showing more specific trade strategies for each phase in the following videos, but for now let's move on to the orange. The orange phase is usually the final crescendo. As you can see, during the 2020 to 2021 cycle, we weren't lucky enough to pump all the way up to red. By the time price reaches the orange phase, your long call exposure should be close to zero, because price volatility levels will be at unsustainably high levels. In post-halving 2024 terms, this would be a price movement above the $200,000 level. As you can imagine, FOMO and retail mania will be in full effect here, and the risk-reward of holding your leveraged long positions is no longer there. The downside would far outweigh the upside at this stage due to the steep premiums options will command. Don't be greedy here. Hedge if you haven't hedged already, or simply look to exit your position entirely. And finally, there's the red phase. Like I mentioned during our breakdown of the orange phase, we weren't lucky enough to get here in the previous cycle. The last time we touched the red phase was in December 2017, when Bitcoin was on a parabolic run towards $20,000, and BVol was trading an extreme deviation above 150. If we're ever fortunate enough to get to the red phase again, and you're brave enough to be long calls the whole way up, this is as good a sign as any to cut that exposure and take a nice long breather. To demonstrate how unlikely it is we reach there in 2024, this would be a post-halving price target of over $500,000. Not impossible, but highly unlikely. If we did by chance get this overextended, it would not be a bad time to get some short exposure by the way of selling calls as they would be extremely overvalued, or longing puts if you'd like to earn some money on the inevitable trip back down. But more on how to execute those trades in the next video. For now, I just want you to take another good look at this chart and internalize its meaning and implications. This is a framework, a mental map to help you become more precise with your options entries, rather than throwing darts in the dark and gambling away your risk capital. Understand it as the key to unlocking options profits in 2024 and beyond if you follow it closely, rather than falling victim to the emotions of the moment, which will surely be blinding.
For now, this concludes our intro to trading Bitcoin cycles with options. In the rest of the series, I'll go over the various phases and show you how to place the best trades in order to maximize your returns. So be sure to subscribe to the Exchange and Good channel below so you don't miss it. Until then, I'm JJ, and I'll see you in the next video.